A record intraday high for the NASDAQ. That's the first since August 30th. Got strong tech earnings helping fuel those gains. Index is up 25% since the Christmas Eve lows. Other high-flying tech names set to report tonight, obviously, Microsoft, Facebook, Tesla, along with Visa. Joining us at Post 9 today, Oppenheimer senior investment strategist Brian Levitt and our own Mike Santoli. Guys, good to see you both.
Thank you.
President didn't mention record corporate debt, the federal deficit, earnings growth going from 20 plus to 0.
Sure.
But we know he's a president who's comfortable dealing with leverage.
Well, without a doubt. I mean, and the markets are arguably kind of looking past those things as well, right? I mean, the market acted going into this earnings season as if companies were kind of get a mulligan and that expectations were low enough. It's more or less gone that way. You know, since the day before we started earnings season, the banks reported a week ago Friday, market's up less than 2%. So most of the gains we've had this year to this new record level happened in anticipation of that. And to me, what really happens during earnings season is the good gets kind of punished. The good gets rewarded to some degree. The bad gets punished. You have offsetting situation where volatility goes down at the index level, and it feels safe for people to stay in the market and buy more. So the suppression of volatility is almost, I think, one of the benefits once the trend has been higher.
Is that how you see it? And does that have implications for inflows in the back half?
Well, look, I mean, this was what we're experiencing now with earnings and with the slowdown in U.S. activity is a lagged effect of a policy mistake last year, which was multiple interest rate hikes. Now we're accommodative, the Fed's on hold, and so what you have now is an environment, where earnings has slowed pretty significantly, but there are a handful or a number of companies that are beating pretty impressively, and that's what investors are bidding up. That's likely to persist through this cycle. I think investors are going to come back into this market. This is a secular bull market. It's unlikely to end anytime soon. You don't have the warning signs flashing, and investors should be involved in this market.
I would say short-term warning signs. I mean, on a tactical basis, is sentiment's getting very comfortable. You look at some of the charts of some of the leading NASDAQ stocks, and look at Microsoft's chart.
Yeah.
Okay, it's gone vertical heading into earnings. Yeah. You have 30 buy ratings out of 34 analysts. What's it going to do to impress you at this point? I mean, and if it continues higher, then it just means we're doubling down on an already good bet.
Which, of course, brings up the key point. I mean, you've had folks point out that, yes, we've hit new highs with S&P and NASDAQ, but it's been mediocre volume, it's been mediocre breadth. How much of this is being powered by those big cap tech names, FANG and Microsoft and the like? Well,
it is. A lot of it is being powered by those names, and that's what you should expect at this point in the cycle. I mean, we've been in this environment for a while now where investors have been hoping that the more value-oriented parts of the market, the staples, utilities, respond and take over. That's not likely to happen in an environment where the yield curve is generally flat, where growth is not accelerating, it's actually slowing. So for this cycle, I mean, we've been on record saying this is going to go on far longer than most people suspect. We put out a note that said 5 more years. And in that environment, unless you get a meaningful pickup in U.S. growth, it's going to be a handful of names. It's going to be the big companies that are able to beat and surprise.
So key question then, when we know that there's been a lot of cash on the sidelines, a lot of investors on the sidelines who are maybe spooked in the fourth quarter, they're looking at this market now and they're going, I want to get back in. Where do they do that?
I think they should be investing in growth, in the growthier parts of the U.S. market still, and they can also be looking outside the United States, places like the emerging markets where Chinese growth is stabilizing and valuations are very reasonable. Look, investors always come up with reasons to not be invested. We heard the president say we're hitting all these new highs. The market hits a new high every 16 days. Right? And we're in a secular bull market. We should expect it to continue to hit new highs. I would say throughout this whole cycle, investors have come up with reasons, whether it was the European debt crisis or the debt ceiling or the fiscal cliff or North Korea or all these other reasons not to be investing. That's not what it's going to be about. So long as financial conditions are relatively easy, the economy's growing at a stable clip, the Fed sees no reason to kill this cycle, equities should likely go higher.